Hi, this is Wise Wolf with a message to encourage you to consider improving your food reserve storage. Inflation is here causing food and energy prices to rise with no end in sight. In this period of economic uncertainty, eFoods Global is making certain that hunger is no option. For a complete product list, go to booksmart.myefoods.com. Again, that's booksmart.myefoods.com. Try eFoods Global. It's the gold standard of food reserves. Welcome to the Wise Wolf Project. I'm your host, Wise Wolf. It is Friday, June 17, 2011, 5:45. The question is, are you listening? Are you listening? And I don't mean, can you hear me? I mean, are you paying attention to the world around you? For the life of me, I've been wondering over the past few months why more banks have not been failing. And I just could not fathom we have 45 banks fail this year, which is a whole lot less than last year. Now, on the one hand, that's good. Less banks failing means we should have a healthy economy. Unfortunately, I believe it is all baloney and phony. We should be having more failures. Why do I say that? Because I recall in 2008, December of 2008 to be exact, 60 Minutes gave a report entitled The Mortgage Meltdown. And everything that I say, you can check out in my box below. And within that, it talked about one of the reasons we were having the housing crisis. The residential housing market was imploding at that time, if you remember. And it had to do with the resetting of ARMs and all of these different types of exotic loans. And one of the things it pointed to was that there was another wave, second wave, that was coming in the commercial real estate sector. And a lot of the smaller banks dealt a lot with the commercial business side. So if we're in this wave, which if you go and watch it, we're in the middle of some tough times as far as the banks are concerned, smaller banks. And I'm like, we should be having multiple bank failures. And I could not figure out what in the world is going on. Well, came across an article at Money and Markets, and he pointed out that mortgage insurers are taking a beating right now. And specifically, he went to PMI, which is one of the major mortgage insurers, real estate insurers, and you just saw the stock just getting pummeled, down like 84% from the beginning of this year. And so then I went and looked at all the mortgage insurers, and most of them were displaying the same characteristic. Their stock values were declining rapidly since the beginning of the year. AIG is a stock mortgage insurer. They have a portion of their businesses in insuring mortgages. Well, when a mortgage goes bad, these companies pay up for that. So they're getting hit up big time. And I said, wow, I hadn't realized that they were getting hit up as bad as they were. And so it's not trickling down to the banks just yet. But once these mortgage insurers either default, go bankrupt, or decide that they don't want to insure any more of these types of loans, it's going to hit the bank's earnings. So we're in an area that is very critical and vital right now. It reminds me of what happened in 2007, 2008. A lot of these companies were getting hit up, and the banks were being shielded from these losses until they weren't. So that is one of the reasons why I wasn't seeing this effect hitting the banks, because the mortgage insurers are getting hit up right now. And I should have known something, because AMBAC, which is a company I was going to do a profile on, and they're a bond insurer. Uh, they actually went bankrupt, I think in late '09, November of '09, I believe it was. They actually went bankrupt. And MBIA is the largest. Them and AMBAC were the largest bond insurers. AMBAC has since gone under, bankrupt. MBIA is still functionally, it's not bankrupt, but it is having a hard time. It's the largest bond insurer, and we already know that states are having a huge time making payments on their bonds. So it's quite possible that MBIA will be getting either a bailout, or they will be going under as states continue to have problems making payments. The next thing that caught my eye was this Greece situation. Now, normally it's not a big deal to me, but as I've done a little bit more research, I found out that Greece goes, we go. Wherever Greece goes, we go. And the reason is because of derivatives. Apparently, we are involved, and I say we as in the major U.S. banks, J.P. Morgan, Wells Fargo, etc., we are putting out credit default swaps, and I'll explain what that is, on European banks. And there was an article written by John Malden, and he's going over what the numbers mean. So let me line up for you what's happening. Governments, just like the U.S. government, sells bonds. Well, they need people to buy those bonds. In this case, Greece has bond auctions, and guess who's buying them? European banks. So the European banks are holding Greek bonds, but Greece isn't really good for the money. So banks like to hedge. And so what they've done is they've taken out an insurance policy on the bonds that they've bought from Greece. And this insurance policy, quote unquote, is called a credit default swap. Now, the U.S. banks have been giving them CDSs to the European banks. So much like if you were to buy car insurance, you buy a policy, and that policy is based on your risk. How risky the company feels you are determines what premiums you pay. So each month you pay a premium, and they give you coverage should an event, let's say a crash, happens. So this is what has happened. So the European banks have taken out credit default swaps on their bonds, their Greek bonds. And every month they're paying J.P. Morgan, Wells Fargo, Bank of America, Citigroup, these major banks, they're paying them on a monthly basis. So the banks, our banks, are getting monthly cash flow from this. However, if should an event happen, and in this case it's a default is the event, i.e. credit default swap, our U.S. banks have to pay the European banks to cover their losses from the bonds that they bought. That's where the problem lies. It is very likely that Greek is going to default. Just a few days ago, Standard & Poor's lowered Greek's rating, which means it raised their borrowing costs. Well, if it costs more for them to borrow, it's the same way with you and a credit card. If they jack up the interest rate on you, the likelihood that you're going to pay off that card goes down and down and down. So to the point to where at some point you're going to say you're just not going to pay at all. Well, in this realm, we're talking about a default. If Greece gets to the point where they say they can't pay or they won't pay, that's a default. Well, in that case, the European banks are owed a large sum of money. Probably, and I'm almost positive, more than the cash flow they've given to the US banks, which means the banks, our banks, are going to experience a huge loss. And this is the reason why Greece keeps getting a bailout. People keep saying, why won't they just let them fail? They're not going to let them fail because the U.S. banks, and the European banks for that matter, do not want to lose money. If they have to they've spent billions of dollars trying to keep Greece afloat. And their money, their capital, is wrapped up in these deals, in these bond deals and in these swap deals. So they have a lot of money at stake. If they have to come off hundreds of billions of dollars, do you know what's going to happen to our banks? See us, sayonara, sucker, so long. It's over. They will go bankrupt. And you want to know what's going to happen to the unemployment rate? It's going through the roof. So the question I had was, why would a bank knowingly, I would never take that bet on. You are a risk, but it's all about money. They don't care. Because why? Who's been paying their bills so far? You have, America. You have, taxpayer. That's why they don't care. That's why they continue to put up these swaps, these derivative products, because at the end of the day, it doesn't matter whether they win or lose. They win regardless. Look at what happened just a few years ago. When Lehman failed, what you saw was derivatives imploding. That's why the stock market was going haywire. That's why the bond market was going haywire. That's why the commodity markets were going haywire. Derivatives and everything is daisy chained to somebody else. People are making side bets, and should those things go bad, they have to come off of the money. But they don't have the money. And it's a wonder. This supposed dodd-frank bill, which was supposed to ensure that no further deterioration could happen in our financial markets, does nothing to deal with this. It is reported that we have at a minimum, $600 trillion of derivatives worldwide. Do you know how big the GDP of the world is? 60 trillion. So we have liabilities that are 10 times the amount that the whole world can generate. If a portion of that 600 trillion, and that's the low end, mind you, the high end is over a quadrillion. Nobody really knows since it's unregulated. If a small portion of this goes haywire, in other words, an entity loses a bet and can't pay, the whole system, world goes into a depression automatically, hands down. No way you can stop it. No way. But this is the type of stuff that's going on. So when I ask you, are you listening? Are you paying attention? It is imperative that you surround yourself with proper information. It is imperative that you surround yourself and read. Read. CNBC is not my idea of fair and balanced. Fox, CNN, you need to go to some alternative sources, unfortunately, because you're not going to get the full picture. And mind you, while I'm speaking about Greece, it applies to Ireland, it applies to Portugal, it applies to Spain, it applies to Italy. You remember these pig nations? We have our banks are loaded to the gills with credit default swaps. And should they go down, should they default, we're on the hook. And I say we as taxpayers, even though you didn't have anything to do with it. Because what's going to happen is once Greece defaults, once Ireland defaults, once Portugal defaults, once Spain defaults, once Italy defaults, they're going to transfer the losses just like they did in 2008 onto the backs of us Americans. You need to wake up. You need to understand what the repercussions of this is, because it means you will get poor. And it won't be just the Greeks out there rioting. It won't be just the Egyptians out there rioting. It won't be just the Tunisians out there rioting. It won't be those in Bahrain rioting. It's going to be us here in America. We are seeing the devastation and the depression take hold. I hope you have ears to hear. That's my time. Remember, the invisible is more important and more powerful than the visible. Think about it.